Hi, I'm Si Yan, and today I'll be presenting to you on the analysis and research on the company that I'll be researching on Bloomberg and all over the internet, which is known as Far East Hospitality Trust. For my research and analysis on the company, I'll be using fundamental analysis, which is a method used to analyze stocks by looking at a company's financial statements and information. This will allow investors to find out how companies are performing, whether the stocks are underperforming or overperforming in comparison to the companies or industries. It will be divided into two parts: qualitative analysis that will then be broken down to financial stability ratios and performance indicators. Financial stability ratios are useful to check the financial strength of the company and its cash flow patterns. I've also used performance indicators for my analysis as they are useful to find out the performance of the company. As for qualitative analysis, I'll be using SWOT analysis, which I will further elaborate on the last slide. Another way to do an analysis on the company is to compare Far East Hospitality Trust with other companies in the industry. I have selected two peers that I have extracted from the Bloomberg Excel file to compare with Far East Hospitality Trust. It is best to compare with companies that have near or almost the same market capitalization. Therefore, I researched from Bloomberg that the possible peers are Fraser Centerpoint Trust, which has a capitalization of $1,735 million, and Capital Retail China Trust, which has a market capitalization of $1,314 million. Debt to equity ratio is the ratio of total liabilities of a business to its shareholders' equity. It is a leverage ratio and it measures the degree to which the assets of the business are financed by the debts and the shareholders' equity of a business. According to the charts, there is a slight increase of debt equity ratio of 0.02% between 2012 and 2013. It is still considered low ratio as it is below about 0.45 is good enough, because this shows that the company has a low values of debt and is therefore exposed to less risk in terms of interest rates increases or credit rating. I have found out that the operating margin ratio is used to indicate net profitability of the operation of the business. It is the percentage of revenue that a company generates that can be used to pay the company's investors. It is a key measure to analyze a stock's value. For Far East Hospitality Trust, I have analyzed that it has increased to 68.9% in 2013, which means that it is earning more dollars of sales. The operating margin is 68.9%, which means that the company is making net operating income of 0.7 for every $100 generated, which is a good sign. Comparing with the competitors, Far East Hospitality Trust has outperformed their competitors. This shows that Far East Hospitality has been efficient in their business and it has demonstrated profitability in its business. Return on asset is an indicator to show how profitable a company is relative to its assets and ability of management in generating profits from assets. Based on the charts, the company has dropped to a return on assets of 4 from its normal ratio of 6.2. This shows that the management of the company is not really that efficient in utilizing its equity base. The company is not effective with each dollar of asset it holds. When comparing against its competitors, the ROA of Far East Hospitality Trust is the lowest. This means that it has underperformed its competitors. Competitors are doing well because the higher the ROA values, it will be better as the companies are earning more money on less investments. I have also used return on equity as my analysis because it is useful to compare the profitability of a company to other companies in the same industry. Return on equity is expressed as a percentage of a shareholder's equity. The ROE of the company has decreased over the years from 2011, but based on what I have seen from the chart, all are positive values. The company has performed better in 2011, and this could probably be due to the opening of the 2 casino integrated resorts in 2010 that resulted to strong growth in visitor and tourist arrivals. This will mean that more tourists will lead to higher profitability, which in turn will attract foreign investors and local investors more. However, in 2012, the ROE has dropped tremendously, and this could probably be due to the tentative economic issues over the last 2 quarters of 2012. When comparing against other peers, I've expected these high-growth companies to have higher ROE. Far East Hospitality Trust has underperformed as compared to its 2 other peers, as competitors have higher ROE. I've learned that earnings per share are calculated from the net income divided by the number of outstanding shares. Earnings per share are used to indicate the profitability or market prospect ratio of a company. Based on the chart, for a comparison of 3 years, it shows that there has been a continuous improvement in the EPS figure, as it has increased greatly from 2012 to 2013, with a difference of 0.04%. This is also an indication of improvement in the earning power generated from the company. The EPS for the company over a 3-year period is moderate. For one ordinary share, an investor earns 0.05 cents. I believe the company's earnings will still increase gradually for the next few years. The net profits of Far East Hospitality Trust has increased from 2011 to 2013. It has increased as it is expected to be resilient due to higher supply of hotel rooms. Another reason why it has increased could be due to Singapore's economy performing well in 2013 despite the appreciation of the Singapore dollar and concerns over the recovery of the global economy. Furthermore, research has shown that international visitor arrivals to Singapore in 2013 grew 6.9% to 15.5 million from the previous year due to strong growth in both leisure and business travel, which eventually increased in profits. As for the net profit margin, Far East Hospitality Trust profit margin of 68.9% shows that the company has a well-planned competitive strategy and has good control over its expenditures. From 2012 to 2013, there is a huge increase in the earnings. When it is increasing, it is signaling that there will be more net profit per $1 net sales. So a 68.9% profit margin means that the company has a net income of 70 cents for each dollar of sales. I've also did a comparison against its competitors for the profit margin. Net profit margin is very useful, especially when I'm comparing companies in similar industries. Comparing to the other 2 companies as above, it has shown that Far East Hospitality Trust has underperformed one of its peers, Fraser Centrepoint Trust. The higher the margin, the better it is. One competitor, Fraser Centrepoint Trust, has higher profit margin, which indicates a more profitable company which has better control over its costs. I think that dividends per share is actually quite similar to earnings per share because earnings per share show what shareholders earn through profits, whereas dividends per share show how much the shareholders were actually paid by dividends. Dividends are a form of profit distribution to shareholders for every ordinary share issue. It is used to indicate that the company's management believes that the growth can be sustained. Over the 4 years, Dividends per share for the company have decreased from 2011 to 2012 and are increasing over time after the period. And I believe that long-term investors are looking for it, and it will be very rewarding for the company. For the qualitative analysis, I'll be elaborating some points on the SWOT analysis. The strength of Far East Hospitality Trust is it has strong backing by Far East organization. It has strong growth in leisure and business travel. It has experienced management. It is one of the largest hospitality players in Singapore, and their assets are serving various market segments. Why do I say that it is one of the largest hospitality players in Singapore? This is because based on the research that I've done on the internet, the portfolio is located in one of Asia Pacific's fastest growing hospitality market. Far East Hospitality Trust initial portfolio offers exposure into Singapore's growing hospitality sector, which is one of Asia Pacific's fast-growing markets. Furthermore, the research has shown that prospects for the sector continue to remain robust in the coming years. It is also one of the largest hospitality players in Singapore. An initial portfolio of 11 hotels and service residences of 2,431 rooms are valued at close to 2.1 billion will make the trust one of the largest single owners of hotel and service residences in Singapore. Based on its ratio given, the trust will benefit through lower operating costs as it is able to spread these costs and share services across the portfolio to achieve operational efficiency. The weaknesses are not all assets are located within the traditional tourist-centric areas. The country are considered concentrated risks. This is because Far East Hospitality Trust derives 100% of its revenues from the Singapore hospitality market. For the opportunities, there are positive tourism outlook that focus on the growth in leisure visitors with more new local tourist attractions. And lastly, for the threats. The threats are this could be due to economic slowdown or recession. Economic slowdown in the region could affect demand for travel, which is leisure and business and accommodation. This will then affect performance and earnings for shareholders. Besides that, intense competition from competitors can result to competition from current and future upcoming hospitality. I've come to the end of my presentation. Thank you for your attention.